Hello and welcome everybody to the Creating Powerful Retirement Accounts for Business Owners and Real Estate Investors webinar. This is professional real estate investor David Campbell, and I want to say thank you for joining us today. We have a fantastic faculty joining us from UDirect IRA Services. We have IRA expert Karin Hall. And from Keystone CPA, we have the smartest tax advisor I know, Amanda Hahn. This is a great chance for everyone to learn and to share ideas. Keystone CPA and UDirect IRA Services are in Southern California. My business is located in Northern California, but we reach people from all over the globe through the power of technology. And it's great to be able to serve a very diverse group of customers. So let's get started and see what we can do to help this brain trust come together with a great conversation. So what today is, it's about fostering relationships and sharing ideas, both us sharing with each other, you bringing up some great ideas for us to have a conversation about. It's really an enlarged conversation about taxes and about financial strategy and investing. You know, when you're in business on a day-to-day basis, you get to have conversations like today all the time with your team. But when you don't have a team around you, it's great to attend events like this so you can kind of eavesdrop on conversations of people who are working in the field and see what they're thinking and be in touch with the newest ideas. And this is also opportunity for you just to understand what types of teams are out there so that you can build your own team. And we want to be really clear, this is not a sales pitch. There's nothing for sale today. You can just relax and understand that this is a pure educational event. Really, our entire sales pitch is just helping you be aware that our companies exist, and hopefully you find enough value in today's presentation that you want to reach out to us and say hello and see what our companies do. This is not investment, legal, or tax advice. So even though I work very heavily in investments and Amanda is a CPA, we talk about legal things, we talk about tax things, and we talk about investment things, but this is not advice specific to your situation. So make sure that you're getting proper representation. And very big disclaimer right up front, we do not currently represent you in any investment, legal, or tax matter. This is intended to be general education material. So today's agenda, we're going to be learning about how to pay ourselves instead of the IRS, learning how to get more income and pay as little as legally possible with the goal of financial independence. Some people think of financial independence when they have gray hair and they're grandparents. Some people think of financial independence as something that they can achieve as soon as possible. And it is possible to retire earlier than you might think. So we're going to talk about a lot about the changes in the tax law that are coming up and what to do about it, especially for people who are investors and business owners. If you're on this call today, you probably know that business owners and investors have more loopholes or more tax benefits than those people who are purely working a job. So here's a great picture of our fantastic faculty and some links to our websites and who's on the call today. What's fantastic is Amanda Hahn and Karin Hall are on my team, and so when I need a go-to tax person, I go to Amanda, and when my clients or myself need support in self-directed IRA investing, Karin is the person I go to. And so it's really great that Karin, Amanda, and I have conversations like this all the time, and for our audience to be able to kind of eavesdrop on that call is really kind of a special one, and we're excited to have you here today.
I'd like to do the honors if you don't mind. This is Karin. You know, David he's a great example of how really anybody can do it. Obviously, he's a really intelligent man. I think he was a high school band director and decided to get into investing and became a self-made millionaire. I mean, how do you like that? Just from your average teacher to somebody who's been investing in real estate and really knows his way around. And as the screen says, he's a real estate investor, developer, broker, and manager, and he is the host of our webinar today. And again, I thank you, David, for the opportunity to speak on your webinar as your guest.
Well, it's a great synergy, and thanks for that really kind introduction. So when I work with a client, the first thing in determining how to get to financial independence is coming up with a roadmap. And it's been said, ready, aim, fire. I mean, you have to know where you're going before you go there, right? Or you could aim at your foot and you'll hit it, right? So when I work with the client, the first thing I do is just kind of assessing where do they want to go, because your financial strategy is very different, or your IRA strategy is very different if you're trying to retire in 5 years or 10 years or 20 years, and depending on what age you're starting with and how much money you want at retirement. Those are all very different things. And then assessing your resources. And when I was teaching as a high school band director, I didn't have any money, and I didn't have any credit. I was basically broke and trying to figure out how do I get in financial independence for my family, and I figured out the teaching wasn't really going to do it, and I got into real estate investing about 12 years ago, and it was a fantastic vehicle for me to create financial independence at a very young age. So picking the vehicle to match your goal is very important, right? If I wanted to retire at age 60, then staying as a teacher for 40 years probably would have been the best strategy for me, because it's a pretty secure pension. But I didn't want to work for 40 years in a classroom working for somebody else. I wanted to accelerate my retirement. So that really plays into the strategy. What kind of vehicles are you going to use? What assets that you have other than financial? It could be your time, it could be your knowledge, it could be your strategic relationships, it could be your control of a good deal, it could be the town that you live in, right? I actually took a teaching job in a town that I thought had a great real estate market, because I wanted to be very close to that particular real estate market and to be hands-on in my investing. And so I moved. I moved away from my family. I moved away to a job that I didn't really want, but it was advantageous because it got me close to the real estate action. And that was just part of the tactics that I used to implement my strategy. And so when you're working on it to create financial independence, it's important to know your role. And I really encourage everyone to think of their position as a generalist. And Amanda is a specialist. She is very highly specialized in tax, right, and how to use the tax code to the advantage of investors. Karin is a specialist in using the vehicle of self-directed IRAs to create wealth and to defer taxes into the future, or in some cases potentially eliminate the payment of taxes. And so when you are an investor, I really encourage you not to think that you're going to memorize the tax code and become a property management expert and a tax expert. It's impossible. Each of those fields is so specialized. Your job is to be a generalist and to get a team of people around you that when you have a tax question, you can call your tax advisor. And when you're looking at how to implement your strategy, the first thing is to get a team, and that's kind of what today's call is basically an interview, a job interview. We're interviewing for you, and you're interviewing for us to see that if potentially we want to be part of your specialist team, your team of specialists. When I was teaching high school band, my goal was $50,000 a year of passive income. And if you've played the cash flow board game, which we do at my office on the second Saturday of each month, if you've played Cash Flow 101, Robert Kiyosaki's board game, you'll know that the lower your current income is, the easier it is to replace with passive income. And here's an interesting example, right? If you are trying to get $50,000 and your strategy is, I'm going to buy bonds and I'm going to buy certificates of deposits and savings accounts because those are safe and secure, and your goal is $50,000 a year of passive income, you need $2.5 million of capital to save up. It's working for you at 2% to produce $50,000. And this is, of course, this is pre-tax, right? So you aren't even going to necessarily get to keep $50,000 because how that income arrives on your balance sheet could change how much tax you pay on that particular income. And we'll talk about that a little bit later. But for me, I wanted to get $50,000 gross income per year. And I figured if I could get $2.5 million at 2%, well, there was only one problem with that, which is if I could only save $1,000 a month as a teacher, I needed to save for 2,500 months, and I wasn't going to live that long. I wasn't going to teach that long. So it was literally impossible for me to create financial independence if I was shooting for a return of 2% per year on my money. So then I said, well, let me look, what can I do at 5%? And then I talked to my financial planner, also known as mutual fund salesperson, and the mutual fund salesperson says, well, they could get me 5% of my money because historically that's about how mutual funds have been performing, and they felt comfortable basing a financial plan around a 5% annual return. Sometimes better, sometimes worse, but a blended 5% was reasonable. But I had the same problem, which is I needed $1 million of capital invested at 5% to produce $50,000, and if I was only saving $1,000 a month as a teacher, it was going to take me 1,000 months to get to $1 million. And what most financial plans are based around is the idea of equity, spending your equity, or principal reduction. And so they say, well, you know, you can retire with only this much money because we're going to be depleting your principal on an annual basis. And that didn't seem like a very good idea to me. It's kind of like the farmer who gets their seed at the end of the season and decides instead of saving it to plant for the next year's crop, they decide to go cook it up and eat it and have some bread. And that's really kind of very short-sighted, because what happens if technology changes and you live longer, right? I might die at 90, but what if there's some amazing technology invention that allows me to live to 120? And that extra 30 years, how am I going to fund it if my financial plan was based upon depletion of principal or depletion of equity? And I might not know that that technology exists until after my working years. I mean, I might base my whole retirement and retire at 65, and they come out with some really cool technology that allows me to live to 120, but I think, oh no, I based my whole life plan on dying. And I thought, death is not a really good financial plan. So how do I get higher returns? And that's when I really started looking at what types of investment opportunities were available to me. And I figured out that real estate investors can hit 10% returns pretty consistently. You know, as a real estate investor, if a deal isn't producing at least a 10% blended return, I'm usually passing, right? And blended return could be from cash flow, it could be from equity growth from amortization as your loan is paid off by your tenant, it could be equity growth from appreciation as the property goes up in value, it could be from inflation where you buy a property with using financing, and when you sell the property, you're able to pay that property off with devalued money because of inflation. It made that mortgage cheaper to pay off. You're paying it off with devalued currency. And so when I look at all of those blends of returns, you know, 10% seemed like a minimum threshold as an investor. And the difference between a 2% return and a 10% return is astronomical in the gross dollars that I needed to save to be able to retire. Because my goal was not to be $2.5 million of net worth. It was to have $50,000 a year of cash flow. And, you know, having made a fortune and lost a fortune in real estate, it's really powerful to me to say, would you rather have a very high net worth and no cash flow, or would you rather have lots of cash flow and no net worth? And having lived through both of those situations, I can tell you I would much rather have a high amount of cash flow and no net worth. And net worth, what is it? It's meaningless until you're using that net worth to work for you and produce income for you, so that you're living on the proceeds of your investing rather than you're living on your principal from your investing. So then as an investor, you know, sometimes you get into good deals that produce, you know, upwards of 20% returns or better. And the way that you get to those higher returns is through leverage. It's through using financing. It's by looking at your after-tax return. because maybe I might make 15% on a real estate deal, but I didn't have to pay taxes on it. All of that money was tax deferred, or even better, potentially tax free. So would you have $15 that was tax free, or $20 that you had to pay tax on? And I'd rather have $15 that was tax free than $20 I had to pay tax on, because my tax rate living in the high tax state of California is going to be higher than a 25% tax, blended state and federal.
David, this is Amanda. It's that rate is actually going to increase significantly in less than 6 months.
That really makes it even more essential to do your math based on after-tax dollars, isn't it? When you're spending the money, you spend the money post-tax. But when you invest, you want to make sure that you're looking at how much do you get to keep after you've paid everybody, including the tax man. And so why tax deferral is so important is, looking here, for example, at these two charts, you can invest 12% outside of the IRA and pay taxes on it every year, or you could put that same investment inside a tax-deferred vehicle like an IRA. Even whole ownership of real estate outside of an IRA can give you some form of tax deferral as well, but really the best tax deferral can come from inside your IRA. And that tax deferral over 30 years, when you look at how much you are not compounding your money, let me say that in the opposite way, when you can get an interest-free loan from the IRS, meaning you don't have to pay the taxes in the year that you earned the money, you can then take that money that you would have paid Uncle Sam with, go out and invest that money. You can look over 30 years, that's a huge difference in how much money you get to work with. And it's like almost a 300% difference in the pre-tax versus the post-tax. So we talk a lot about taxes because taxes are the largest expenditure that we have in our budget. The average American spends more money in taxes than they do in food, clothing, and shelter combined. And as Amanda just said, it's only going to get worse. And so, first of all, let me just give some kudos to Amanda. Fantastic CPA. She represents my personal tax matters as well as that of our companies. And she gives great advice, not only reactively, but proactively. So if I say, Amanda, what did I do? Can you help me figure this out? She knows. But if more importantly, I say, Amanda, my goal is to pay as little tax as possible. Can you help me do that? She's very knowledgeable in helping specifically business owners and real estate investors figure out how to take advantage of the strategies, not just reactive, but to create proactive strategies to lower your tax obligations. So, Amanda, tell us about what's happening with the tax law and where are things going and what can we do about it?
What you were saying earlier about was, would I rather have $20 or $15 depending on if I have to pay taxes, and you can see that taxes are definitely set to go up on the slide. And you were saying we have people from all over the U.S. that's coming to that's actually on this call right now. State taxes are different as well. Here on the slide, you'll see what the current tax rates are, and if you go across the board, you'll see that federal taxes at 35%, state taxes, payroll, capital gains, estate taxes. You were saying earlier about death not being a good financial strategy. Well, death is also not a good tax strategy either, because we have to pay taxes when we pass away too. And what they say is death and taxes are unavoidable. With the recent healthcare decision, I know all of our listeners and our presenters as well, you've all been following, or at least you're aware of the healthcare decision. What that means as a result is that taxes are set to increase. And so as we sit here in July, we have less than 6 months before the new tax rates kick in. And it's really amazing to see in the second column, 2013, federal income taxes are set to rise. For state income taxes, obviously, depending on what state you're in, it may rise as well. California, there are definitely talks of taxes going up for us here. Payroll taxes, fortunately, will stay the same. capital gains tax is going up, and that's very important for all of us who are looking to build our wealth. That's, and that's whether you're investing in the stocks and bonds market, you're investing in real estate. We have to be prepared, and the first step of being prepared is really knowing what the changes are going to be. Now, we're talking about, death not being a good tax strategy. You can see that starting in 2013, the estate taxes is scheduled to go back up to 55%. In terms of the tax rate. What's more importantly is that the exemptions is also going down as well. So right now, the first $5 million worth of estate is not going to be subject to estate taxes. But in 2013, the exemption goes down to $1 million, which means if your estate, whatever is above $1 million, that potentially is going to be subject to a 55% tax. Isn't that amazing? We talked about the tax rate increase on the previous slide, which is astonishing on its own, and the estate taxes and all that. The new tax that's coming up here, if you haven't heard it before, it's called Unearned Income Medicare Contributions Tax. And that's a really long word, but essentially, don't let that title confuse you. The easiest way to look at it is this is a brand new tax on investment income. And when we say brand new tax, we say it's new because it's a new tax that never existed before. This is something that was just conjured up in the Treasury Department to help pay for the deficit and Medicare issues. So this tax is going to be an additional 3.8%. That's going to be assessed on top of what we're currently paying in terms of income, payroll, capital gains, and all those other things. And it affects taxpayers with $200,000 of income per year, or $250,000 if you're married filing joint. And it's important to know what types of income we're generating would be subject to this new tax. And here's a list of those examples. Interest income. Earlier, David, you were talking about having money in a CD. So the interest you earn in a CD, for example, would be subject to this brand new tax. Dividend income, royalties. For real estate investors, rental income is also potentially subject to this brand new tax. Now, a little bit later on, we're going to talk about ways that you could protect your rents from this new income. But generally speaking, those types of activities are also included in the new tax coming up. Also income from passive activities, and by that what we're talking about is if you invest passively in deals. For example, you have an ownership in a partnership or a LLC. Okay, if you're passive in that activity, then you're potentially subject to this new tax as well. And then, of course, gain on sale of assets. And by that, it's, selling stocks, selling real estate, selling a piece of land. All of these are defined as investment income and potentially subject to this new 3.8% tax. So it's really important for all of us as we build our passive residual net investment income that we proactively look at ways to protect ourselves against this brand new tax. Now, if you might think, okay, well, so I have some investment income, but most of my income is, I work for my income. I either have my business or I'm working full-time at my job. So in that case, am I protected from the new taxes? Well, here's where the next new tax comes out on this next slide. And this is the hospital insurance tax. And again, don't let the name of this mislead you. It's not a tax on hospitals or insurance companies. It's a tax on all of us here on this call today. Okay? This is yet another 0.9%, affects same exact profile, people who make $200,000 per year or combined $250,000 as husband and wife. Now this impacts all of us because this is imposed on earned income. And what's the definition of earned income? Well, you can clearly see it's on W-2 income, income from sole proprietor. So if you're operating as a Schedule C, self-employed individual, essentially all earned income would be anything that's not passive income. that's not investment income on the previous slide. So you can see between the two brand new taxes, the IRS has essentially captured everything, right? Because we make money either by investing for it or working for it. And so between the two, they'll be able to increase our tax bill either way. Taxes is never simple. So when we talk about the income threshold, keep in mind that's before a lot of the deductions. It's before deducting your primary home. It's before deducting all the charitable donations you make. So we're talking about, above the line. So adjusted gross income prior to all of your itemized deductions. And so a lot of people who may not think this affects them, because, honestly, not a lot of people feel they are part of the higher income that is subject to new taxes or higher taxes. But when you really take a look at it, like you said, David, it's really affecting middle-class America. Another thing that you brought up is a great idea is, on the education and how investing can actually protect you from some of these taxes. We're actually currently at Keystone CPA, we're working on 50-plus tax strategies that you can use to protect yourself from these types of incomes. And today, I really want to talk kind of broadly about two of those strategies. The first one is real estate investments. I mean, you hit it on the nail. With real estate investments, what I love about it, both as an investor myself, but more importantly as a CPA, is that you can utilize what we call paper write-offs, meaning take tax deductions without actually having to write a check out every single year via depreciation. And that's really just the government allowing you to take a depreciation on the value of that property that you purchased. So, on a property, let's say you buy a commercial building, for example, for $1 million. No, we know we can't get that in California, but let's say we were able to get a commercial building for $1 million. Well, what you can do is you can take a tax write-off of that purchase price of $1 million over multiple years. And this is true regardless of whether or not the value of the property increases or decreases. You still get that deduction. And also, most real estate investors, you want to use leverage to buy your properties, which means that on a $1 million property, let's say you put $100,000 down or $200,000 down, well, your depreciation deduction is still calculated on that entire $1 million purchase price. So it's really a great way to take a tax deduction on money that you may not have spent, right? So taking a tax deduction for the bank's money. And that's really, really great when we talk about the new taxes that are coming up on investment income, because real estate is one of those rare asset classes that allow you to utilize depreciation. So, if we spent money, if we put $10,000 in and bought a stock, for example, there's no depreciation deduction. So whatever the returns that we get, we would pay taxes on it. We're paying, depending on what kind of return we have, so we're paying taxes, and we're also paying the new taxes of that 3.8%. Real estate, on the other hand, we're deducting a lot of the expenses relating to the real estate itself, plus depreciation. A lot of times, if you're working with a tax advisor who specializes in the real estate, for the most part, you should be paying, little, if any, taxes at all. And that's why, when earlier, David, you were talking about, using real estate to build long-term wealth from a cash flow perspective. Here's another reason why real estate is a really great investment in looking at the tax side of things, is to be able to get that either tax-free or tax-deferred income coming through. Now, speaking about tax-free or tax-deferred, let's move on to the next topic that I want to cover, the other strategy that you can look at to help protect you from the upcoming taxes, and that's really retirement planning. What I love about retirement planning is that it could be used by anyone, business owners, high income earners, low income earners, also W-2 earners. So essentially anyone can use retirement planning strategies. There's so many of them that I know Karen is going to be sharing a little bit later on. But essentially the goal is, in light of the rising taxes, what you want to do is put away retirement money for a couple reasons. One, what you contribute into your retirement account, you can get a current tax deduction for, right? So, we're talking about, let's say you're someone who is at $200,000 a year in income. Well, what if you put $5,000 away into your retirement account? Now, that potentially lowers your taxable income to, $195. And what that means is now all of a sudden you're not going to be subject to these new taxes that are coming up just with a simple contribution into your retirement account. Another benefit of retirement strategies is that money within the retirement account works and grows for you tax deferred, just like in the example that David showed earlier, in the difference of investing within your IRA and outside of your IRA. And so now, in light of the new tax increases, not only are you being protected from the old taxes, but you're also going to be protected from the new taxes that are coming up as well. So that's the second benefit. Now the third benefit, which is a really great one, is you might say, well, that's great, I'm getting a deduction, it's growing tax deferred, but what's going to happen when I take all of my money out, when I retire at distribution? Am I then going to be hit with a huge tax bill? Well, the good news is that the new taxes that are being imposed, both the hospital insurance tax and the new investment tax, neither of those will be calculated on distributions of money when you take them out at retirement.
So let's say I had a property inside the IRA and a property outside of the IRA, and I'd fully depreciated both of them, so depreciation is not an issue, and I was going to get that dollar of rent, and let's say I'm 70 years old, I'm going to take that dollar of rent, direct ownership of property, or a dollar of rent to my IRA and then distribute that dollar to me. Which of those mechanisms gives me a lower tax bracket?
Well, in light of the new taxes that are coming up, starting in 6 months, you would have a lower tax bill with that dollar of rent in your IRA, because when you take that out as distributions, it wouldn't be subject to the new investment tax.
Yeah, so that's an important change because, even last year, the answer would have been it's the same. Am I correct?
Mm-hmm. Yes.
Yeah,
well, even as we sit here today, the answer is it's the same, but that's about to change in less than 6 months.
Yeah. And so that is an important, really key distinction that I want to make sure that our real estate investors on the call are getting, is that if you're buying property for your long-term retirement ownership, that depreciation, aside, because there are a lot of benefits to having that depreciation outside your IRA, but some people can't use it necessarily. But assuming that depreciation is not a factor, having that income in your IRA is going to be, even when you're taking distributions, is a better tax strategy.
Yeah, when you're looking at overall planning and wealth building, it's always really good to look at everything, like you said. You want to look at how much money you have to invest, both within your retirement account and outside of your retirement account. And it's really important to have a plan in place so you know how to maximize and leverage both of those components to make sure that at the end of the day, you're keeping the most in your pocket. Now, we talked about the retirement plan strategies and what a great tool it is to both help us, minimize current taxes and future taxes. What's more powerful than just the traditional IRA, 401k, SEP IRA, is really the Roth IRA. What I love about the Roth is that it provides us with the ability to have permanently tax-free income. So when we put money into a Roth IRA and we utilize that to invest, let's say we'll take an example of a piece of property, a single-family home. You buy a single-family home in your Roth IRA. Well, what that means is that all the rental income that you receive within the retirement account is never going to be subject to taxes. And when you eventually take that out at retirement, that's also going to be free from all sorts of taxes. And it's really important for us to consider, for anyone on the call, if you're someone who in the past has been in a high tax bracket, because maybe, you know, both of you, husband and wife, are both working, or if one of you is in a very high income bracket, you know, a very high income earner already. A lot of, you know, in the past, it may have been a situation where you weren't able to contribute to a Roth IRA, but there are opportunities where you can convert money from your traditional IRA or 401k into a Roth as well. And it's really, really important to go through this exercise with your team of advisors this year, because if we want to make a Roth conversion, we want to do it this year before taxes increase in 2013. Okay? So if you haven't done so already, be sure to take a look at this strategy. It's a way for you to permanently shift a bucket of money from taxable to permanently tax-free. And of course, we want to do this within the next 6 months before the tax rates go up. So what now? What does this all mean? Like I said, there are so many strategies, and really today we want to focus on just the real estate and the retirement planning side. Now that we've put money away into our retirement, we don't just want to leave it there, right? Have it sitting there, you know, maybe invested in CDs or something like that. And Karen is going to be talking about what are some of the things that we can do with our retirement account to make sure that it generates huge returns for us.
So let's welcome to the call our distinguished IRA expert, Karen Hall from UDirect IRA Services.
Thank you, David. You guys bring up so many good points on, excuse me, about how important it is to save for retirement first off, and how to do it without just completely losing everything to tax. And self-directed IRAs are such a great way to do that when, you know, when all the money can be basically, you know, put in tax deferred. I mean, just tax deferred is the greatest thing. I own UDirect IRA Services, and we're a third-party administrator, and we provide self-directed IRA accounts, but we don't give tax advice. That's why Amanda is part of my team. And we don't give financial advice. That's why David is part of that team. And we also don't give, you know, legal advice and so forth. We have lawyers that work on our, you know, for us too. So we're here to tell you how to self-direct. What's really great about self-directed IRAs is you could, for example, buy a rehab house for resale within your IRA if you wanted to. You could buy anything except life insurance and collectibles. There are so many different things you can buy. But let's talk about the kinds of plans that you can self-direct, and let's talk about their contribution limits and so forth, so we understand IRAs a little bit better. We'll just wrap up the last few minutes that we have remaining on this topic. So the kinds of IRAs you see here on the screen include the traditional, the Roth, the SEP, the simple, and spousal. But you know, there's another kind of IRA that you can also self-direct, and that's an inherited IRA or a beneficiary IRA. And we get those a lot. I mean, you talk about, and Amanda was talking about estate taxes, and you know how when someone passes away, if they have someone designated as a beneficiary, the IRA passes directly to that beneficiary, and it doesn't, you know, factor into the estate tax. Isn't that correct, Amanda?
Yes, that is correct.
Okay, and so that's really great. So whenever you get an IRA, make sure that you indicate your beneficiary so that the money, the IRA money, can pass to them tax deferred. That's crucial. You know, traditional IRAs, pretty much that's 90%, maybe 80% of what we do. A traditional IRA is the kind of IRA where you can make contributions to it as long as you have active income. You can contribute $5,000 if you're under 50 and $6,000 if you're 50 or older. So it's a good kind of a vehicle. The contribution you make is tax deferred, so you tell your tax person that you made that contribution, and they will deduct that from the amount you ultimately owe in tax. So that's good. The Roth IRA is very similar to the traditional because the contribution limits are just the same. So $5,000 if you're under 50, $6,000 if you're 50 or over. But the Roth IRA has other bells and whistles. One of the things is if you make over about $100,000 or so as a single person, you can't even contribute to a Roth. But the good thing about the Roth is when the money's in there, you don't get that tax write-off, but the proceeds do grow tax-free for life, so that's very cool. A SEP, that stands for a Simplified Employment Plan, and a SEP is for someone who's self-employed. It's like a traditional IRA in that you can make the contribution and deduct it. And by the way, the contribution limit's really high in comparison. It's 25% of your income or $50,000, whichever's less. So that's really great. So the Simplified Employment Program, or the Simplified Employment Plan, the SEP IRA, is great for self-employed people. There's also a Simple IRA, which stands for Savings Incentive Match Plan for Employees. SIMPLE is an acronym there. And that's another great employer plan that has minimal costs as compared to a full-blown 401k plan. A spousal IRA, that's interesting because that's the only time you can make a contribution to an IRA where you don't have active income. If you're married and your spouse has active income and you're the stay-at-home spouse, you can still contribute $5,000 if you're under 50 or $6,000 if you're 50 or over. So all those IRAs are there too. And the next kind of section is qualified plans. And so mostly qualified plans are employer plans. But we did include on here the individual K, which is a hybrid account. But UDirect, we don't provide the employer plans because that's a different kind of thing. We provide the individual plans, the plans just for one person. The profit sharing, defined benefit, 401k, 403b, these are employer plans, and they have special rules because they are for an employer and the employees. So they have different rules and different asset protection elements. But the hybrid between the IRA and the qualified plan is this great kind of plan. I was just talking to my staff about this today. It's called the individual K, or the solo K, and I love that plan because as long as you're self-employed and you have no full-time W-2 employees in any of the companies that you own, thank you very much, David, you're eligible for an individual K, and it's got a lot of bells and whistles. I mean, it's got a lower retirement age, so you can begin to draw your money out without penalty at 55 instead of 59.5 like the others. You can borrow from an individual K, $50,000 or 50%, whichever is less. You can't borrow from the other IRAs. You can, actually the individual K has what they call a Roth bucket. You could opt to have part of the individual K money be Roth money. Up to this year, it's up to $17,000 a year can go in as a Roth, contributed as a Roth, regardless of income. Very powerful. If you're under 50, that's more than 3 times the amount in a regular Roth, and there's no income ceiling. Also with an individual K, you can avoid a certain, sometimes when IRAs can be taxed, and you don't pay that tax in the solo K. Also, a solo K can invest in an S corporation, where none of the other IRAs are allowed to invest in S corps because of the way S corps are structured. So a solo K is just so much more. It's just like it's an IRA on steroids. It's a great plan. So if you're self-employed with no W-2 employees, that's a good thing. And David, do you have anything to say about that?
I was going to say, yeah, on the idea of being a generalist rather than a specialist, if you like the idea of solo K, if that appeals to you, I just want to highlight a video that Karin, Amanda, and I created specifically on the solo K plan, and you can find that on our website, hasslefreecashflowinvesting.com.
That's great because there's just so much real quality information there. I think it would be very, very useful. You know, other kinds of plans that you can self-direct aren't even IRAs at all. They're not even retirement plans. One is a Coverdell. It's also called an ESA, or Education Savings Account, where you can contribute $2,000 a year to a child's education. So that could mean college education. That could even mean private school education. As long as it's education, one child or one individual, it's usually a child. I guess it has to be a child. Can have a multiple amount of people contribute up to $2,000 a year, and that money can be self-directed. Also, the HSA, or the Health Savings Account, can be self-directed. That's pretty cool. And here's the deal on that. First, you talk to your health insurance agent, and you say, do I qualify for a high-deductible health plan, an HDHP, high-deductible health plan? And if you do, the HDHP comes with the option to have a health savings account. So here's the thing. You make a contribution to the health savings account, you get a tax write-off, so you get that tax break. The money within the HSA grows tax-deferred, tax-free, and as long as you use this account for a very, very long list of medical expenses on the Department of Treasury's website, the money comes out tax-free for life as well. So an HSA is tax-free money. It's very, there you go. It's a great thing, and it's something to look into. So if you qualify for the high-deductible health plan, you can have this health savings account and self-direct that into whatever assets you like. Right now I've got some people using HSAs to make microloans to people, and they keep making the loan, they get the money back, they make the loan, they get it back, and their HSAs are really growing. Very, very powerful, because by the time we all retire and become older, our need for medical expenses, the medical expenses we experience really does increase, and so here's a tax-free way to pay for that.
One of the things about HSAs is generally those wind up being relatively small accounts. Am I correct? The amount of money people contribute to an HSA, and then the fact that they're taking withdrawals from it on a regular basis, generally people are winding up with a small balance in their HSA. Is that a fair statement?
Yeah, it is. It really is. And by the way, the contribution limits on an HSA is around $3,000 for an individual, around $6,000 for a family. So you don't get to put a lot of money into it, but you know, it depends on how you use it. If you're a family that's always going to the doctor, you always have other things going on, well, you're going to be removing money from that, but you're still using it for its intended purpose, so that's still fine. But it's to say that you can really supercharge it and take a look at it just as an investment vehicle. Pay your own medical expenses out of your pocket, save those receipts, but let your HSA build and build and build tax-free for life. So that when you've got the big expenses, that they don't really kill you, or really damage your financial situation at the time.
Yeah, I want to point out another recording that the faculty made together, which is how to invest when your IRA balance is small. And for people who are specifically looking at using HSA as a tool, your IRA, you might wind up with $100,000 or $200,000, and you want to go invest with that into real estate, self-direct that into some powerful tools. You can do a lot with 6 figures, but when you've only got $10,000 in an HSA, how do you really invest that effectively? Real estate syndications could be one. Microloans is great. Hard money loans where you're participating in partnership with somebody could be a work. Or just really, there's a great video that's a free video that we have on our website that you can watch on that very topic of how to invest when your balance is small.
Yeah, it's crucial, and there's so many things you can do. So let's go on to the next slide. How do you self-direct? And then we'll wrap things up since we're approaching 1 o'clock. But basically, it's a 3-step process to open an account, get that account funded, and once there's money in your self-directed IRA, then to invest. So the way you start is you go to our website, which is the letter U, udirectira.com, and find the kind of application for your account type, maybe a traditional, maybe a SEP, maybe a Roth, whatever you have. And then the very first page, that's called the intake page. When you type on the intake page, it autofills the rest of the document. So you really just fill out one page, even though our application is about 24 pages long. You really are only filling out the one page because it's going to autofill. We need about 6 pages back. We need a copy of your driver's license, a copy of the statement from the account you're transferring, and there's a $50 setup fee. Also, by the way, our annual fee is $275 a year. That's a flat fee, regardless of the number of assets in the account and regardless of their value. So
that is a fantastic bargain. I know many IRA companies that charge a percentage of your account, and if you've got a lot of money in that account, that can be a huge expense for you that would really drain on your overall return.
Yeah, we want people to use their IRAs and become truly wealthy. And so once you do open an account and it's open, now we want to get your money in there. So there are 3 ways to put money into that IRA. Number 1 is you write a check for your annual contribution, and how much you can. That's when you want to call Keystone CPA or your tax advisor, because it depends on your age, your income, your account type, and all those things factor into how much you can contribute. Then another way to put money in an IRA is transferring. An IRA to IRA transfer. You fill out our transfer form and you sign it. You give it to us and we sign it. We send it to your custodian and they put the money in your new self-directed IRA. And the third way is called a rollover. With a rollover, you don't fill out our form. You just go directly to your old 401k or 403b administrator, tell them you want to roll over your old employer plan, fill out their documentation, and then the money will come over. It takes, right now our average turn time is about 16 days on that, so plan for that in advance. And once your account is funded, the money's come in, we send you an email anytime money is posted to your IRA, so you know it's time to invest. And So to do that, you give us a direction letter and the supporting documentation. That would be like a purchase contract. And then you tell us what you want to invest in, and you are off to the races. You are self-directing your IRA just like that. So 1, 2, 3 is how it works. So if you'd like more information about what I'm talking about self-directed IRAs and what you can do with them and how they work, please give us a call here at the office. Our toll-free number is 866-538-3539. Their website, I should say, is udirectira.com, and I can be reached khall@udirectira.com. So Amanda and David, I just so thank you for letting me be the guest here today on the webinar, and if there are any questions, I would love to field those.
If you didn't attend live and you do have a question that the faculty didn't answer, feel free to email the faculty to get that question answered. Just want to invite everyone to our next event coming up in August. It's called the Taxmageddon, and that's going to be at noon California time, and on August 23rd via webinar. And I really hope that you can join us. Look for your inboxes for that kind of that invitation when it happens. Really appreciate the audience. Appreciate your time today with investing in your own financial education. I value our relationship with the fantastic faculty. And if there are any questions, we'll take them now.
While we wait for the questions, I just want to bring up a really important point. You know, going back to one of Karen's slides with the different types of accounts that you can self-direct. You know, she had the IRAs and the individual K, the health savings account. It's important to know that all those accounts are not mutually exclusive. So in any given year, you could potentially contribute to multiple types of accounts, and that's a great way to be able to start, you know, reducing current taxes and also setting aside some money to invest for you tax deferred.
Great point. So we've got some great questions for Karen. Karen, we've got a question from Kenneth. He says, Karen, can you provide some assistance with how one might structure an investment vehicle where he could co-mingle IRA money with other investors who would be investing parallel with him?
It just depends on what kind of legal structure you're looking at. But when it's a syndication, you form an LLC. However, if you form the LLC, your IRA cannot invest in it, but you can pull other people's money in that way.
Another solution, tenants in common. If you don't want to go the route of a syndication, if it truly is a partnership where all the parties are active, you could consider a tenants in common ownership, or even a limited liability company where it's a partnership, not necessarily a syndication, but where people are actively contributing resources other than cash. Kenneth, your trouble is if you're actively contributing resources other than cash to the deal, then it's potentially a disqualified transaction for your IRA. Yeah, so that's a complicated question, Kenneth. I'd be happy to shed more light on that if you wanted to talk on the phone offline. I can give you some insight on that. Jonathan asks, should Americans worry that the rules of any of the investment vehicles change? For example, if they decide to add a tax on Roth distributions with the current presidential administration, who knows what they will do? In short, Jonathan, I think you have every right to worry, because if you can predict what our government is going to do, you are a lot smarter than anyone I know.
Yeah, I've been to Washington, D.C. at least once this year so far, and I haven't heard anything about a potential tax on Roth IRAs. Have you, Amanda?
No, and that's really a great question, because I do get that quite a bit when we're working with clients and running the numbers to see, if we were to put money into a Roth, or if we were to take all of our retirement money and convert it to a Roth. Of course, people are going to be concerned on, can you guarantee that in the future I'll never pay taxes on the Roth money? And of course, the answer is no. There's no guarantee. But from a planning perspective, here's what I say. Just because there is a slight possibility that sometime down the road the taxes may be changed and there could be some component to where Roth gets taxed, that doesn't mean that we shouldn't today look at what are the strategies to still use that vehicle, right? Because when we do planning, we can only do it based on whatever is the most current and accurate information. So what you don't want to not take action just because down the road, potentially something could change. I mean, everything is always changing. All we can do is to make the best decision based on the current landscape and on the most current knowledge. And yeah, I mean, myself, and I know in speaking with a lot of colleagues in my industry, we don't anticipate them to assess taxes on Roth or come up with a new tax on Roth IRAs, although, that could potentially happen. It's just that there's nothing that's being said about that at this point in time.
If you have further questions, feel free to email us or visit our websites for more information. Hope you can join us on a future educational event, and I wish you have a very successful and lucrative investing experience and pay as little tax as you are legally obligated to pay and have a wonderfully abundant life.